Welcome to our latest video chat in the Money Show expert interview series. I'm Mike Larson, editor-in-chief at MoneyShow, and today I have the pleasure of speaking with Tom Hayes, founder and managing member at Great Hill Capital LLC. Tom, I appreciate you taking some time out to chat with me today.
Thanks for having me, Mike.
Right. Given the news we got on the inflation front this morning, as we record this, I can't help but start there. What do you think about the trend in CPI, and what implications do you see for the Fed and Fed policy this year?
Well, it's a big deal. This was a very important report. Expectations were that it was going to come in hotter than expected, and it actually came in cooler. We've got a 4 handle in front of headline at 4.9% year on year, so that's very promising. But I do think the biggest number was the owner's equivalent rent and shelter costs, which are starting to come down. They finally peaked. They're really coming down on a month-on-month basis, and on a year-on-year basis, they're starting to slip down as well. And that's a major component of CPI. And what we're going to see with the 12-month lag on the leases is that those are going to start to drop more abruptly in coming months. And that's going to give the Fed a lot of cover to actually move ahead with the pause that they implied at the last press conference.
Got it. Well, how does this fit into your overall market view for the next few months, the next couple of quarters? I mean, I've had a range of guests, some who are kind of bearish on the outlook for 2023, some who are a lot more constructive. Kind of in that spectrum, where do you fall?
Well, we saw earnings come in, Mike. This quarter estimates were on March 31st were that they would decline by 6.7%. They're actually, with 85% of the companies having reported, down 2.2%. And estimates for the first time in months have actually started to move the other direction, meaning up, not down. So while everyone's been very, very skeptical about the markets, you are seeing 2024 estimates still hovering around $246 to $250 for the S&P. And with them now moving in the upward direction, those might not be as unreal. They might be more realistic than people are estimating. And if that's the case, we know the market is a discounting mechanism. So just as the stock market discounted the weakness we saw in Q1 and are expected to see in Q2 last year with a 27% peak to trough correction in the S&P 500, I think as we move out here in the coming weeks and couple of months, the market's going to start to look ahead towards 2024 recovery, and we may actually find a bid in the market, which is very constructive when you consider earnings going up, inflation going down, Fed being on pause. That's a formula for good things to happen.
Got it. Well, Tom, you provide a wealth of information on the website you founded, hedgefundtips.com. So first, anyone watching, be sure to check that out. But second, I saw the quote of the day you posted there earlier this week was from Charlie Munger from Berkshire Hathaway. And he said, the number one rule of fishing is to fish where the fish are. So, kind of keying off that, what do you like about that quote, and where do you think the biggest fish, so to speak, are in this market?
Yeah, I think the fish are where the valuations are lowest and the growth is highest. And we've seen this in other tightening cycles, but the one area that's really been left for dead that no one wants to touch, that's going to represent a huge opportunity in the next 12 to 24 months, which we're going to talk about at the Money Show in August, is going to be emerging markets. And if you just look at emerging markets, there's a mean reversion trade in the making. The 10-year annual performance, average performance was 1.8% for the emerging markets, which is anemic, versus the S&P 500 at 12.06. Now that comes after a 480% return that emerging markets had from 2001 to 2007. So what do we need to happen in order for emerging markets to get bid? Number one, we need the dollar to remain subdued and start going down. So we saw the dollar peak in October. It's been coming down. What's happened? Emerging markets have been going up. And we see earnings growth after 3 years on average of mid-single digit earnings growth. For China, which is the heaviest weight in the emerging markets, it's now projected to be 18.5% for this year and 14.5% for next year. So we think that's going to be a trend for the next 12 to 24 months, and we'll go into that in detail.
Got it. Got it. Just to put my sort of, I wouldn't call it gloom and doom, but maybe cautious hat on. I mean, you had another quote from Peter Lynch of Fidelity warning that stock market declines almost always accompany recession. So, and then at the same time, you've got, this banking sector issue looming in the background. A lot of people talking about commercial real estate exposure and so on. What is your take on those risks? Do you think they're overstated? Do you think that we can get all past that in general? I mean, I just kind of curious as to what you'd have to say on that.
Yeah, well, we did have a technical recession last year, and you had a correction to accompany it. So the first 2 quarters of 2022, you did have negative GDP growth. So we have that kind of in the rearview mirror. Commercial real estate, Moody's did a study on the impact to banks' balance sheets, and it's much lower than people could possibly anticipate. Right now, the market is trading as if commercial real estate is going to overwhelm the balance sheets. But I think when all is said and done, it's a maximum exposure of 8%. And that's if all commercial properties drop by 40%, which is certainly not going to be the case, because as the labor market loosens up, more and more people are going back to the office to get face time and to be part of the community. Because what they're finding is that on average, the bulk of the layoffs have been with the remote workers, not the ones that are coming into the office. So I do think that the commercial real estate is overestimated. I do think we had the recession in the rearview mirror, and it's not out of the question that we couldn't have a negative quarter or 2 quarters of GDP growth before the recovery next year as the lagged effect of the tightening. But I do think we did a decent job of pricing a lot of that in the 3rd and 4th quarter of last year. So we remain open-minded. We will change if the data changes. But for now, we are in the soft landing camp, and we do think earnings are going to reaccelerate.
Got it. Well, you gave a little bit of a sneak peek there at what you're going to be talking about this August in Las Vegas at the Investment Masters Symposium, emerging markets, opportunities there versus domestic. Anything else you'd want to add, and anything maybe on the flip side that you're cautious about for the remainder of the year?
Yeah, I think your biggest risk for the remainder of the year after we get through the debt ceiling in the next few weeks is really going to be the Fed making the mistake of overdoing it. The Fed has 2 tools at their disposal. One is balance sheet runoff, which they've not used quite as much as they potentially could have to drain liquidity. And the other is the Fed funds rate and overhiking. And I think they've used more of that than they probably needed to. So I think moving forward, what we want to see is a situation where the economy can handle the hikes that are already in place, 500 plus basis points in about a year. And that the Fed takes the signal from the market with the deterioration in some of the regional banks, with things starting to break. And they say, let's leave it here and see how things work through the system. If they have to cut once or twice, they can do that. I don't anticipate they'll have to. I think if they pause now, it's the perfect situation, kind of a Goldilocks scenario where they can keep rates elevated to continue cooling things. And at the same time, the economy can press forward. But the real risk is if they do 1 or 2 more unnecessary cuts, and that could just be the straw that breaks the camel's back. So we're betting on the Fed here to be sensible, to be data driven, and to maybe pause at these levels.
Got it. Well, Tom, thank you so much for your insights, and thank you all of you for watching. If you'd like to hear more from Tom and dozens of other top market and economic experts, I do encourage you to check out our upcoming Investment Masters Symposium. It's going to be at the Paris, Las Vegas from August 8th to August 10th. Keynote addresses, panel discussions, coffee breaks, cocktail hours, again, with some of the top market experts. Just click the link in the video description below and find out how you can join us. Tom, thanks again for your time.
Thanks, Mike.